Hey, my friends. So, we're going to continue on with how savvy real estate investors take advantage of a market shift. So, let's talk about what I know a lot of you are interested in, flipping houses. And you're probably wondering, hey, if we're going into a recession, if we're going into a crash, if we're going into this crazy world with market conditions are all over the place, real estate's all over the place, can we do what you want to do, which is flip houses? I get it. I wrote a book on how to flip houses. So let's talk about that, because there are definitely going to be some opportunities in flipping that are going to go away, but there's going to be some opportunities where you can still flip. You can make that quick cash in real estate. So let's talk about some of the things to be cautious of. There's some things you should be extremely cautious of. So first and foremost, going into a market like this, I think it's very, very important that you understand the importance of medium priced housing in your market. Okay, medium price housing. I'm talking about what is that medium price point of home in your market. So in my market, it's around 225 or so. So where our investment business is at, about 80% of what we do is at $200,000 and below. You know, I said 225 is a medium price housing price point. We love to price houses at 199, right? Like, we know those houses are going to move, they're going to sell. This is a very, very, very critical number for you to understand in your market, right? And so the reason why that we try to buy houses that we can price at a medium price point and below is, number one, when it comes to marketing, that's where the abundance of deals are in any market, right? So you have a higher percentage of getting those deals first off, because you've got an abundance of sellers and abundance of properties. Number two, you have abundance of buyers. Number three, and this is critical, whenever we go into a market crash or recession, or, you know, I'm going to talk about this in a little bit, a lot of times it's not necessarily a housing crash, it's a financing crash. People want the properties, they want the houses, they just can't get the financing, and that's going to be a big risk moving into this, you know, unknown future where we're moving into. But that median price point is very critical, because it gives you sustainability in the event that you have to rent a property, in the event that you, you know, your plans of flipping doesn't work out the way that you want. You're not getting crushed by high holding costs and by high taxes and insurances and things like that. So that's one of the first points that you need to use caution with, and know your median price point of housing in your market to safeguard yourself in case plans don't work out. And the good news is, I'll let you guys know that I speak about this from experience after doing hundreds of homes. I went through a down market before. I had a property, I was trying to flip it. I couldn't flip it, and I let it sit months and months and months vacant on the market. And I was like, man, I can't, this isn't sustainable. So I ended up taking a renter in, and it wasn't a big cash flow type of deal. I mean, I was barely breaking even on this property, but I will tell you that renter stayed in that property for 7 years, and I sold it, had the same tenant in. He was late almost every single month on rent, but he paid his rent every single month and his late fees. I sold that property 7 years later for almost $100,000 more than I had invested in it. So there's kind of a little forecast on what can happen when you buy and hold properties. Another thing that you need to be cautious of, very cautious of, is the financing industry. I mentioned this already. Keep an eye on what's going on in the financial markets and in the lending market with mortgage companies and with the big banks, right? Because like I said, we may not have so much of a housing crisis here soon, because we've got very low inventory, which is good for us as real estate investors. But if financing goes away, you may not be able to flip your property. So that's one thing you need to be cautious of, right? You need to be very, very cautious of that. So I hinted on this a little bit. Avoid the high-end market. So what is the high-end market? So see the previous thing that I mentioned about knowing the importance of your median price point housing. I would be very cautious going too far above that median price point home. Do we sometimes flip houses above that are worth more than $225,000? $25,000? Yes, we do. Currently, I have a property that I'm flipping for $459,000 and actually went under contract on very first day, which is rare for that price point, but it did. I have another house that I'm selling for $530,000 or $535,000, something like that. I had another one recently for $265,000, and we're about to put one on the market for $350,000. But you have to understand 80-20 rule. That's 10 to 20% of the deals that we do. We do take some shots in higher end markets, but these are typically markets, these are typically deals where we're buying them cheaper than your standard buying formula. So we're getting them really, really cheap. And also those are very, very hot markets, typically extremely low days of the market, right? But we also use not on all of these deals, but we also have lending. We work with lenders to create equity participation deals where I'm not going to get into that too much on this conversation, but we safeguard ourselves in those deals, right? It should always, your mindset should, with any deal, should always be heads I win, tails they lose, right? Like you want to safeguard yourself, and that sounds kind of bad, but you want to make sure if the worst case scenario happens, you're protected. You're protecting everything that you do. So avoid the high end. You have to realize luxury, whenever the market crashes, whenever the financing drops out, the luxury higher end market is going to be one of the first markets to drop, along with condos, along with, second homes, vacation rentals, commercial market, all that kind of stuff is going to fall first. That's why we love the median price housing and below. It's very safe. It's very sustainable, which leads me to this: multiple exit strategies. Whenever you're flipping in a market going in like this, you have to be prepared to rent that property, right? And that may mean that you may be saying, Brant, I don't think I can get long-term financing. I may not be able to, finance this property long-term. Well, then that may mean that you need to bring on a money or credit partner, right? And that's one of the things that I did in 2008, because in 2007, I was flipping houses at the peak of the market. I'm sorry, I wasn't flipping houses. I was buying rental properties. and refinancing them in long-term money. But whenever the market stopped, the financing market collapsed, basically, I had to begin creating partnerships so I could continue buying real estate and buying rentals. And I did that with my partners. So don't let your mindset stop you thinking that you can't, just because the market is down or your credit is bad or you don't have the experience. And because if you believe that you can't, you can't. But if you believe that you can, your mind will automatically gravitate and go find the way that you can get it done. And that may be with money or credit partners. So also when it comes to multiple exit strategies, be able to rent it, look into owner financing. Owner financing is a strategy that I love. I know that some investors say, oh, there's downsides. You don't get the appreciation. You don't get the tax benefits. I get it, but it is a great hedge. It is a great predictable source of income, and I absolutely love the model. Be prepared to flip it to another investor. In 2007, whenever I mentioned like that market collapsed and I couldn't get financing, 2008 I started buying rental properties, continued buying rental properties. In 2009 I was still buying rental properties, but at this point in time I quit my job as a full-time real estate investor. I needed some additional cash rather than $100 or $200-$300 of cash flow my rental properties were giving me. So I began buying, fixing, and flipping rental properties and then flipping them to investors. Now the margins weren't as good, but they still produced some income for myself and my family and my business. Think outside the box. So I don't even know, where we're going into. I don't know where specific opportunities are going to arise from, but I guarantee you that there's going to be some ingenuity that's going to come from this market. You see it in every market shift. Whenever a shift happens, Americans create that. American ingenuity is going to come about. Look at the Airbnb business model, for example, which I'm not a big fan of. I'm not going to get into that right now, but the Airbnb model, is a great idea and is a great his investment strategy, when done wisely, it is really good. Even though I'm not a big fan of it, doesn't mean it's not. You can make a lot of money with it. But that's just an example of ingenuity. Look at these shipping container houses. Look at tiny homes. Look at a friend of mine's developing fourplex communities for the over 65 buyers and communities, and he's selling them to an individual owner who will own the fourplex, and he'll be able to lease out the other 3 units to like the over 65 community, because a lot of the baby boomers don't have money. What other opportunities will come? I'm not sure yet. I just know that keep your eye open and be thinking outside the box. Some of you are wondering about new construction developments, or any opportunity there. I'm almost 100% no on new construction. That being said, we're about to break ground on a new construction project. And so why are we doing that? One, it was already in the works 6 months ago, and we've just had delays getting to this point. So there's exceptions to almost every rule, right? You have to understand we've got the macro market, which is the overall market, the real estate market of the U.S., and we've got the micro market, right? Where we're building this particular house. Makes great sense. And it's also, once again, friends, in that medium price point that I mentioned. So we'll be able to, I think, quickly sell the home. But who knows? Maybe we'll have to rent it. Maybe we will own or finance it. I don't know. But the thing is, with new construction, whenever now in this market we're going into, theoretically, there's going to be a surplus of motivated sellers because people are losing their jobs, right? Companies are going out of business. Small business owners are going out of business. People can't upgrade to buy that other home that they've want. There's all of these problems that come in the market when a recession, you get into divorce rates go up and all this kind of stuff. That being said, that should lead to a surplus of inventory of motivated sellers, and that's what we want. Additionally, when we go into a time like this, there's a decrease of real estate investors. I mentioned this in part 1 of this video series. If you haven't seen it, part 1 and part 2, I touch on that. And so with that being said, because there's an influx of supply, the supply that we like, the amount of real estate investors, the market has decreased. That means there's more opportunity for us to find the ideal type of properties that we want. And that's fix and flip properties, right? Houses that we can put a little bit of work into and get a big return. We've done multiple deals this year that will house properties that we flipped that we've made 6 figures on, $100,000 on a flip. I would much rather make $100,000 on a flip where we do make ready, rehab, whatever. Even if the average new construction deal, let's say you made $100,000 on a new construction deal, I don't care. I really don't like new construction. There's more risk, there's more work, there's more headaches. With a new construction deal, you have to understand you're not buying it today and selling it tomorrow. You're buying that land, developing it, going through all the permits, the engineering, all that type of stuff. It may not be going to market for 6 to 12 months. The real estate market's going to be completely different. So in my opinion, in other words, there's too much risk, not enough reward with a new construction deal. And that's in a lot of markets, to be quite honest with you. You can use your time and resources to do more deals with more profit. And it's an opportunity cost factor. New construction deal, new construction development right now is probably going to take you away from other and greater opportunities, which may be rental properties, which could be short sales, which could be subject twos. A lot of things that we're going to discuss and coming up in the series. So keep watching. Before you go away, check out our resources page at Real Estate Fundamentals. If you're not a member or a subscriber of this channel, get subscribed. Go to Real Estate Fundamentals. Go on the resources page. There's a lot of resources for real estate investors out there building a business. Share a lot of content on this channel, on that page. Get signed up to our email list, and I'll send you some private messages as well to help you along in your real estate investing business. So continue on to the next video. We're going to talk about rentals, well, how savvy real estate investors are taking advantage of a market shift with rental property.